Well, the office subsector is quite interesting at the moment because after several years, we're finally getting some rental growth in office. And it's mainly Sydney and Melbourne where the story lies. And in AREIT portfolios, that really represents between 70 and 80% on average of their portfolio. So let's talk about those two markets. In Sydney, it's a supply story or a lack of supply story. There's been a lot of withdrawals for residential conversions, for hotel conversions, and also to build a lot of the metro stations around Sydney CBD, which means that they've had to take some buildings offline. So all that withdrawal has led to vacancy coming down together with some positive demand in the market. It means the vacancy levels are down to about 4.6% at the moment. In Melbourne, there is a little bit more supply, but there's been strong demand, and again, vacancies have fallen down to 4.6%. So it's a demand story in Melbourne. With those vacancy levels below 5%, we think there's probably another 12 to 18 months of reasonably strong rental growth to come in those markets. One of the things that we have to keep in mind is that values have increased a lot, not just in office, in all property asset classes or property subsectors. But office has contracted a lot. We now have a situation where cap rates in Sydney and Melbourne are well below 5%. So we're hitting all-time low in cap rates. So values are very elevated in the expectation of the rental growth. So it is hard to see that cap rates will continue to contract to a significantly further extent. With that, we have a situation that valuations are well over replacement cost. In other words, the cost of building new buildings. And so that makes new development a lot more viable. And so developers come into the market and bring in new supply. So that will be what we'll get. We'll get a supply response. What that means is that around 12 to 18 months out from completion of those new buildings, the developers will need to be more competitive on rents to attract tenants to fill those buildings. And so you're looking at rents perhaps starting to slow down around 2019, 2020. So that's why we say that we've still got another 12 to 18 months of rental growth. In the last few years, there's been quite a few floats or IPOs of stocks exposed to suburban office in particular. And they offer good yields. Stocks like Australian Unity Office Fund, Garda Diversified Fund, to name a couple, run by good quality managers who really know how to operate in those markets and who own very decent quality properties in those suburban markets. And so we've found some good yields and good value overall in those stocks. So in the large cap names that are exposed to office properties, largely they're weighted more towards large CBD office properties and at the prime and premium end. And a lot of investors focus on that. They like the fact that they're large liquid stocks and that they're buying the best quality buildings in the CBD locations. What happens when that occurs is that value gets picked over quite quickly and better value resides in some of the small cap names that we've been talking about in terms of suburban office markets. And so in our experience in the past is when value gets a little bit stretched in the large cap office stocks, then people start to look for value down the line. They start to cascade down to these smaller names looking for better yields. And that's when we make good relative performance because we try to get set ahead of the herd in those stocks.